Good evening, ladies and gentlemen, distinguished guests. My name is Weijian. I'm the founding director of USF Center for Business Studies and Innovation in Asia Pacific, CBSI for short, and professor of international business in the school management. Welcome to today's special event, Money Machine, the foreign acquisition that changed the game for China, and hosted by CBSI and supported by the President's Office. I'm delighted to see a few trustees here, and CBSI Advisory Board members, and USF leadership team members in the audience today. For those of you who do not know about the center, CBSI is the San Francisco, Silicon Valley-based thought leader, learning hub, and bridge builder, connecting the university and the business world, and connecting US and Asia Pacific business communities. In its 9 years of operation, CBSI has become a prestigious and visible platform connecting scholars, practitioners, policymakers, students, and alumni. CBSI is the only research center at the USF that focuses on international business and leveraging the Jesuits' historical connections to China and Asia, and 500 years of Jesuit tradition of linking global education with commerce. Today's event epitomizes the center's vision to be a thought leader, learning hub, and bridge builder for the US and Asia Pacific. The timing for Dr. Weijian Shan's talk on his new book, Money Machine, can't be better, given what has been unraveling in the American banking industry lately. I bet Silicon Valley bank leaders may have regretted that they didn't read Shan's book a little bit earlier. It is now my honor to introduce to you John Nikolai, who will bring today's distinguished speaker to the stage for a keynote speech, followed by Q&A moderated by Ker Gibbs, the Executive-in-Residence in the School of Management. John Nikolai is the USF Trustee Board Chairman Emeritus. John served as USF trustee for nearly 20 years and actively served on the Finance Investment Committee of the board. He received his accounting degree from USF in 1971. John held various management positions during his Big Four career, including Managing Director of the Ernst & Young San Francisco office, before he was transferred to Hong Kong in 2001. He was the Far East Area Managing Partner for Integration and Tax Services and served as member of the Far East Executive Committee. He has served as member of the Global Management Group and Global Tax Executive Committee. In addition to that, John is a member and Vice President of the International Fiscal Association, IFA, Executive Committee based in the Netherlands. IFA is the leading non-government organization in the world dealing with fiscal matters, and very significant to me. Please welcome John Nikolai.
Thank you, Shelley. That was a very nice introduction, but we need to cut that down in the future. No one's here ready to hear my resume, but I'm really happy to be here today just to serve for this introduction. And I would like to say what you're doing with CBSI is unbelievable and well placed to keep San Francisco in the mix as our gateway to the Far East and Asia Pacific. So let's just keep doing what we're doing. I'm delighted to introduce our esteemed alumnus today, Weijian Shan. Shan, as he likes to be called, is a co-founder and executive chairman of PAG, a leading private equity firm in Asia. He goes by that name. If you read the book he's going to talk about today, you'll learn very quickly why he uses that name. So it's another reason for you to read the book he's going to talk about. With PAG, being, as it was mentioned, as a member of the investment committee, we've been very fortunate that we were an investor in PAG in their first fund. And it has helped the performance, as Jeff Silk will tell you, tremendously help our performance as an investment vehicle, being in private equity groups like PAG. So we're very happy to be an investor, and hopefully we'll continue to be investors in your next funds that you'll raise. In addition, he was formerly a partner of a private equity for TPG and co-managing partner of TPG Asia, formerly known as Northbridge Capital, which may ring a bell since many of you know one of our close friends and supporters at USF was Richard Blum, who was the co-chairman. And Dick has been so wonderful in his life when he was with us with USF, very supportive to our school. So in very good company with Northbridge Capital. Prior to his career in private equity, Shan was a managing director of JP Morgan and a professor at the Wharton School of the University of Pennsylvania. He holds an MA and a PhD from the University of California at Berkeley and an MBA from the University of San Francisco. Shan is a member of the Board of Trustees of the British Museum and a member of the International Advisory Council of the Hong Kong Stock Exchange. Shan is the author of 2 other books besides the book he's going to talk about today, one being Out of the Gobi, My Story of China and America, which is a must-read. If you haven't read that book, you can only appreciate who Shan really is after reading that book. It's an incredible story of what one person has done to get to where he is today. It's a book you want to read twice. The other book, which was near and dear to me, was the story of how American deal makers saved Korea, most iconic bank, which happened after the crash there in the late 90s. Korea being an interesting place as well, with another story that Shan can come back and talk to us about. Today, he is speaking about his most recent book, as mentioned, Money Machine, a trailblazing American venture in China. Money Machine shares a compelling account of one of the most significant deals in private equity history, the first and only foreign acquisition of control of a Chinese national bank, and probably is going to be the last. With that, we welcome Shan. If you please come up and share with us what your views are.
It's much easier for me to take this. Well, good evening, ladies and gentlemen. Thank you very much for being here. I feel greatly honored, very humbled, and great pleasure to be here back on campus. I'm particularly honored that my former professor, Mrs. April Kasu, and her husband, Philip, are here. I am very much humbled by their presence. When I first came to this country, long time ago, fresh off the boat, I didn't know anything. I didn't even know what McDonald's was. And they took me under their wings. But more importantly, I had a very strong desire at that time to go through a formal education program to receive a degree, which I thought if I just came to this country, I would automatically be able to do so. But to my great surprise, when I arrived, that in order to get a degree, you would have to pay for it. I didn't have any money for the tuition fees. And for a while, I was quite overwhelmed by sadness that I came all the way to this country. I was visiting the law school, USF law school, but I would not eventually be able to receive a degree. And prior to that, by the way, I never received any degree of whatever kind as I was growing up in China. For about 10 years after I finished elementary school, China started the so-called Cultural Revolution. During that period of time, for 10 years, there was no school. All the schools were shut. And I was 12 years old when that happened. I was just about to finish elementary school. And then I and my peers were sent to the Gobi Desert of China to do hard labor. And that was the subject of my first book, On the Gobi. So when I came to this country, I didn't know anything about anything, but I had a very strong desire. This way? I had a very strong desire to receive a formal education, which I never had before. But there was this obstacle. And eventually, Mr. and Mrs. Kasu gave an amount of money to the university to cover all my tuition fees, to enable me to get a degree. And they really changed my life. USF really changed my life. And for that, I'm eternally grateful to them. So I'm very humbled. I'm very honored. I'm in private equity business now, and I make investments, as Larry mentioned. And private equity business has become very big. It really started in late 1980s in this country. At that time, there was one firm called KKR, which acquired RJR Nabisco. And it was the largest takeover, corporate takeover, probably in history, $25 billion acquisition by a few finance guys who didn't have much money, and they borrowed a huge amount of money to make that acquisition. And it was sort of the start of private equity business in this country. And over time, it spread to other countries, to Europe, and then eventually to Asia. Now, today, private equity is a very big industry. In this country, there are twice as many firms controlled by private equity as listed on the stock exchanges in the United States. So that's how influential and big that private equity has become. Many iconic companies are owned and controlled by private equity investors. However, there's very little known about this business, even though much is talked about it. If you read the Wall Street Journal, New York Times, every day, Financial Times, you would see multiple references to private equity. But nobody had ever written, before I published my two books, had written about a private equity story from beginning to the end. Now, for KKR's acquisition of RJR Nabisco, somebody wrote a book. Two Wall Street Journal reporters wrote a book by the title of Barbarians at the Gate. And some of you may have seen it. It was turned into a TV series, I think HBO TV series. But the deal was done in 1988. And the book was written in 1989. And so the book only dealt with the deal-making part of that particular transaction. How these guys put money together, negotiated, they eventually made the acquisition of this business. You have a camera over there, and therefore I should have moved move around too much. All right. I'll keep my distance, but I will not move too much. But Henry Kravis was one of the three, KKR, was very fond of saying that any idiot can buy a business. You just have to pay the highest price. It is what happens to a business afterwards that really matters, and that is whether or not it will make money for investors that really matters. If you look into the history of KKR's acquisition of RJR, Nabisco, you would find that they held that investment for 15 years. And eventually, they actually lost money over that particular transaction. So, to understand private equity business, you really need to understand what happens afterwards. After you have made the deal, after you have made the acquisition. And I searched the literature. I couldn't find any single book to provide you with the full story of a private equity transaction from very beginning to the end, from investment to exit. And I thought, since I've had some experiences doing deals, and some of them are rather high profile, I would try to fill that void. And therefore, 2 years ago, I published my second book, which is Money Games, talking about the firm I represented, Newbridge Capital, San Francisco-based private equity firm, going to Korea in 1998 to buy control of Korea First Bank. We bought control from the government, and we turned it around. Eventually, we sold that bank to another international bank and to make our exit. Now, that story was really the basis for today's story, that is the story told in Money Machine, which is a story about how Newbridge Capital, again I represented, acquired control of a national bank in China, which had never happened before, has never happened ever since. We were really unique playing that role and doing that deal, and it's quite an interesting story. But typically, a private equity firm is not allowed to buy a commercial bank. You see, you made the reference, you made the reference, Xiaohua, about the failure of Silicon Valley Bank, Signature Bank, First Republic, and some other banks, regional banks, are also in trouble. So Silicon Valley Bank was sold to First Citizens. First Republic, as we know, was sold to JP Morgan, right? And FDIC, the Federal Deposit Insurance Corporation, had to pay a lot of money to either First Citizens to acquire SVB or to JP Morgan to acquire First Republic. In this country, as true in many other countries, private equity firms are not allowed to own or control commercial banks. There is Bank Holding Company Act of 1956, which prohibits non-banking institutions to own more than 25% of a bank. And that rule actually is very much accepted almost all over the world. So it's very rare for a private equity firm to buy control of a commercial bank. It's even rarer for a private equity firm to buy a national, that is nationwide, bank in any country. How were we able to buy what we call the most iconic bank in Korea in 2000? We started negotiation in 1998, but eventually we made the acquisition in 2000. It was because Korea went through a financial crisis. And this was the 1997-98 Asian financial crisis. And just to give you some idea how severe that crisis was for Asia. And that crisis happened on July the 2nd, 1997, from Thailand, when the currency, Thai baht, suddenly massively devalued. And eventually it spread to all over Asia. Every Asian country was affected. And at that time, I was working for JP Morgan and investment banking business. On October 23rd, 1997, I went out with my wife to a shopping place in Hong Kong, which is called Times Square. So Hong Kong has Times Square as well. It's not as big as New York's, but it's also called Times Square. I saw a throng of people under a big TV screen watching this large screen. And I got close. I saw that the stock tickers were rolling on the screen. And I thought, what are they looking at? What is so interesting about this screen? And then when I got close, I discovered at that particular point, Hang Seng Stock Index, which is the index for Hong Kong Stock Exchange, dropped about 10% by that time, about noontime on that particular day, October 23rd, 1997. By the end of that day, the stock index dropped 16% in one day. Think about it, Black Friday and all that. None of the countries you would see this kind of stock market crash, 16% in one day. That was when I told myself that I shouldn't do investment banking anymore because the stock market would be frozen, investment banking would be frozen, and it would be a good time to get onto the buy side, that is investment side, private equity side. As it happened, 3 months ago, somebody representing Newbridge Capital, Dick Blum, David Bonderman, approached me asking me whether or not I would be interested to join Newbridge Capital. I was not interested at the time, but when I saw this huge change in the marketplace, I decided it was time to switch to the buy side. So on that day, I made the decision to join Newbridge Capital and to join the private equity business. Now, very quickly, that Asian financial crisis spread all across Asia. And the hardest hit was South Korea. South Korea, by 1997, had become the 10th largest economy in the world, a member of OECD. And it has come a long way since the days of Korean War to have developed to that particular stage. But in 1997, the stock market of South Korea dropped 49% in 1 year. That's not the worst part. The worst part is the exchange rate between the Korean currency, won, with the US dollars dropped 65.9% in 1 year, 2/3. So in US dollar terms, the stock market dropped 80% in 1 year. So all the wealth accumulated over decades in Korea was wiped out in that one single year. That was how severe Asian financial crisis was. And the Korean government was running out of money because there was capital flight. When the economy was in this shape, everybody wanted to leave the country. So there was capital flight. Money was leaving the country. And by the end of 1997, the Korean government had only $20 billion left in its foreign exchange reserves. Now, this is the 10th largest economy in the world. Just to put things into perspective, my firm, PAG, today manages $50 billion. Korea is the 10th largest economy. It had only $20 billion left in its coffers. In 3 or 5 days, this country was going to go bankrupt. So the government called upon citizens to sell their gold. to help the central bank to increase the foreign exchange reserves. And by then, about 150 banks failed in Korea. If you think about 2008 financial crisis, 1997 Asian financial crisis was even more severe. So it was at that particular point, IMF, International Monetary Fund, came in. They had to save Korea, because if Korea failed, of course, many other countries, the entire world would be affected. So eventually, IMF came in with a rescue package of $58 billion, largest ever in the history of IMF by that time. But there was a condition. The condition was that Korea had to sell one of the leading failed banks to a foreign investor. So Korea First Bank used to be the largest commercial bank in Korea. It failed in 1997. It was nationalized by the government, and they had to sell it to a foreign investor under the condition imposed upon the Korean government by International Monetary Fund. Why such a condition? The reason was that banking was not done on the basis of credit worthiness of the borrowers, the ability of the borrowers to pay back money. Banking by that time was done on the basis of relationships or industrial policy. In this country, the government seems to like industrial policy more and more, thinking that's the way to develop the economy. And I have seen many countries, including Korea and including China, and to some extent in Japan as well, how industrial policies failed the economy and failed the country as well. So banking was not done in the right way. There was lack of the so-called credit culture in Korea. The international multilateral monetary agencies believed that since there was no credit culture in Korea, you had to bring it from outside. And that's why they imposed this condition that you had to sell this bank to a foreign investor. And it was in the depth of financial crisis. The stock market dropped 80% in US dollar terms. The country was going to go bankrupt. So the government hired Morgan Stanley to try to sell this bank through an auction process. They sent out 40 invitations to various global banks, and only two parties showed up, HSBC and ourselves, Newbridge Capital. So the rest of the story was in my second book, Money Games. Now, why do I talk about the second book before I talk about my current book? And that is because in 2002, China decided to restructure and reform its banking system. And ordinarily, private equity firms will not be qualified to invest in the bank, as I mentioned, by the Bank Holding Company Act of 1956 in the United States. The rules are generally accepted worldwide, including China. But once there is a financial crisis, once there's distress situation, the regulators would make an example. In the Korean situation, if they didn't make an example, they wouldn't have enough bidders to buy the banks. And China also, at that time, was trying to restructure the Chinese banking system. Now, how bad Chinese banking system was in 2002, when we first look at this bank that we eventually bought, it's called the Shenzhen Development Bank, SDB. In 2002, the central bank, which is called People's Bank of China, published a report, and they estimated that the bad loans ratio in China's entire banking system was, by that time, banks were required to have a capital ratio of 8%. So if the bank loses some money, you have capital to make up that difference. In this country, capital ratio is more than 10% today. And in other countries as well. After 2008, capital ratio requirement has increased. So if capital ratio is, let's say, roughly 8 to 10% of the total assets. And if your bad loan ratio is 30% of your total assets, that really means that your bank is insolvent. It's not formally bankrupt, but it's insolvent. So S&P, Standard & Poor, the international rating agency, did a study of the Chinese banking system in the same year, in 2002. And they accepted the central bank's estimate that the bad loan ratio was about 30% across the entire system. And they estimated that total amount of bad loans in the Chinese system amounted to about 50% of GDP. Think about it. In this country, GDP is about $23 trillion. If the bad loan system if the bad loan in the system amounts to half of the GDP, it's a huge number. It's a gigantic number. S&P further estimated, in order to bring the bad loan ratio in China to from 30% to about 5%, it would take about 20 years. So if their prediction had come true, China would have brought down its bad loan ratio to only 5% last year, after 20 years. And that was how bad the situation was. And like in Korea, banking was done on the basis of industrial policy and on relationships, not on credit culture. And since we had the experience of turning around banks, we were invited to look into buying control of this SDB, Shenzhen Development Bank, a nationwide bank. And it was a very good time because China joined the World Trade Organization in 2001. And after that, over a period of time, China was going to open up its entire banking system to foreign competition. But if the Chinese banks were so weak, they would be in no position to compete with foreign banks. So they had to restructure their banking system. And China was also experiencing very rapid economic growth at that time. So they decided, in fact, to restructure the entire banking system. And the regulators made the requirement that each of the Chinese banks will have to take in a foreign investor. And eventually, each one of them took in a foreign investor. For example, the largest bank in China, ICBC, took in Goldman Sachs as a major strategic investor. Bank of China is RBS, Royal Bank of Scotland, which went bankrupt in 2008, and so forth. Bank of America became a major investor of China Construction Bank. But we were the only one looking at the acquisition of control of a nationwide bank in China. So that made the deal very, very special. And it took a very long time for us to negotiate the deal. There were many ups and downs. At times, we thought we're not going to do the deal. We thought we were in the bind. If we were denied the opportunity, we thought we would lose a very good opportunity to possibly turn around a national bank in China. But if we were allowed to invest in this bank, the risk might be too big. We may lose all our money. So it was always a very difficult decision to make. So there were many ups and downs in this deal process, but eventually we were able to buy control of this bank, and we were the only one to be able to do so. And the rest of the story, of course, is in the book. But that is really a groundbreaking transaction that a foreign investor was able to do in the context of the Chinese banking system. I think I'll stop here, and I'll be happy to have a dialogue with Ker and whatever questions that you may have.
Great, thank you very much. Thank you so much, Sean. A fascinating story. My name's Ker Gibbs, and I'm with CBSI. I'm a China specialist here at USF. And what I'm going to do just for the next 15, 20 minutes or so is I'm just going to kind of coordinate the questions. I think we want to get...
Should we stand up or should we sit down? Let's see.
You like to stand, don't you?
Yes, I like to stand.
Great, thank you so much. Terrific, thank you. So I think we were passing out cards for questions, but I think if questions didn't get written out on cards, then I think what we might do is just pass a microphone around and just have a couple of...
I'll collect the cards.
Okay, yeah,
So
collect the cards.
If anybody needs any pens, I'm happy to do that. I'll collect them and then we can go from there.
Fantastic, great. Because we do want to get you involved. But no, it's very much my pleasure to be here, Sean. And I did make some notes for questions, and I think you covered almost all of them in my notes. But let's go back to the beginning, because I very much agree with what John Nikolai said, is that you really have to start with out of the Gobi as a starting point to understand who Shan is. And I wonder if you could continue with that narrative just for a minute before we get into the book itself. And also, maybe a couple of just high-level comments on U.S.-China relations and where you think we are, and especially at the people-to-people level. Because I had the pleasure of meeting Professor Cassot earlier before we started the program, and we talked a lot about the tuition, and that it was a funny story, and it's a charming story, and it's a heartwarming story, and it's very much a story about the U.S. and China. And about the same time you were coming from China to the U.S. to study at USF, I was actually going from the United States to China to study Chinese. And those kinds of stories about just people helping people, that actually was not unusual. It was extraordinary to do it at this level, because not everybody has the resources to be able to do something extraordinary like what the Cassots did. But those things happen all the time. And in terms of just people helping people, as China was opening up. And today you open up the headlines and it's unimaginable. I mean, the relations between our countries has just gotten so bad. But what's your thought on that? Is there hope? And do you feel like the Beijing-Washington relationship can be as horrible as it is, but the people-to-people side can still continue? Or what's your thought, just at a high level?
I think there's almost no question that people to people, the relationship will continue. And if you travel around the world, you would find that there's more commonality among people than differences. At the fundamental level, I think people are very similar. Good-hearted and kind. I'm not optimistic about U.S.-China relations at this particular point. And it's sad, because that relationship has come a very long way. China established diplomatic relationship with the United States in 1979 under Jimmy Carter's administration. And that was really the start of China's open door policy. Prior to that, China was very closed. As I just mentioned, for about 10 years, there was no schooling because of the Cultural Revolution. So I came to this country in 1980 as one of the 1,862 students from all of China qualified to receive a scholarship to go abroad to study in that year. The entire country, about 1 billion people, only 1,862 people were qualified. In that particular year, I happened to check the statistics, about 3,000 to 4,000 people were struck by lightning in China. So your chances as a Chinese at that time to be struck by lightning were twice as high as to be qualified to go abroad to study at all. And it was very rare opportunity And I was able to do so because I did well in exam held by the Asia Foundation here also in San Francisco. And when I first came to this country, I didn't know what I was going to study because I never studied anything before. And the program director of the Asia Foundation said, you should study law. And that's why I went to law school, because China didn't have much of a legal system at the time, he observed, and therefore you should study law, right? And later, of course, China developed its legal system and developed many laws since that time. And I think the issue with China is there are still not enough laws, but when there are laws, enforcement remains an issue. So I think China grew very strongly in the past 40 years, largely because it had benefited from this open door policy, from the relationship with the United States, from the relationship with Europe. Of course, China also embraced free enterprises, the market economy, which explained the growth of the economy. Just to give you some statistics, I went back to China in 1993 after having taught at the Wharton School for 6 years. In 1993, the US economy was 16 times the size of the Chinese economy. Japanese economy was 10 times the size of the Chinese economy. Today, in purchasing power parity terms, the Chinese economy is bigger than the US economy. From 1/16 to become bigger than the US economy. Even in US dollar terms, the Chinese economy today is 80% of the US economy. And at that time, the Japanese economy was 10 times as large as the Chinese economy. Today, the Chinese economy is 4 times as large as the Japanese economy, right? So that's the progress that China has made, largely from the open door policy. Well, maybe that's where the United States regrets that it let China grow so fast.
Actually,
but my thinking is, let me just finish this point. The political relationship between the two countries is bad, but I think it's going to get worse. But the economic relationship between the two countries actually remains quite strong. Last year, trade volume was at all-time high, 700 billion US dollars. So I'm hopeful that on the economic side, on the people side, that relationship will help, that dimension would help break the free fall in the political relationship.
Yeah, that actually was going to be my point, is about the economic relationship. And Shan, you've been talking about the benefits to China of the relationship with the West and the opening up in WTO. But let's not forget about the benefits coming the other way. I mean, it's the benefit to the United States from this trading relationship with China has been tremendous, and we could talk for an hour about that as well. But let's dig into the book itself, and let's go back to the point you made about KKR and Barbarians at the Gate. And one of the things that I wanted to ask you is about how you wrote this book. How did you go about it? Because for one thing, you wrote this book while you had a very demanding full-time job. And by that I mean you were a father of 2 and you were taking care of 2 teenagers while you were also managing about $50 billion of AUM. So that was a fairly demanding thing. But more to the point, the guys that wrote Barbarians at the Gate were journalists, and they were working with public information. One of the things that makes this book so unusual, and honestly, I think I only know of one other book that's even similar to this, and I'm thinking of Tim Clissold's book, which is also about private equity.
Mr. China.
Mr. China, and which is also a fantastic book. But this is so interesting because it's written by someone from the inside. But how did you get away with it? So how did you write this book while not violating all the different NDA, the non-disclosure agreements, and the relationships? Because this book and I agree with Ambassador Bacchus, by the way, who says it reads like a novel. It truly does. I mean, there's drama in here, double crossing, some people you thought were on your side and were not on your side. There's a fascinating character by the name of Zhou Lin, who is this guy? You know, it was just such a fascinating thing. So help us understand how you went about writing this book.
Well, first of all, Kerr, I think you got the time a little bit off. I did have 2 teenager children, but when they were teenagers, I wouldn't have had time to write a book. When they went off to college, I just felt I had much more time.
Got it. So this was an empty nester project.
Exactly. And secondly, in investment business, there are always deadlines. You know, if you're doing a deal, you want to strike the iron when it is hot. And there's no letting off. Sometimes I recorded in my previous book that at one time, I worked straight for 42 hours without stop. When I was in the Gobi doing hard labor, at one time I worked 31 hours. But doing a deal, I worked 42 hours without stop. So because there's a deadline to meet, and sometimes opportunity comes, it may be gone very quickly if you don't seize it. So seize the day is very important. But writing a book, there's no deadline. You can take as long as you would like to take. We exited from this particular bank in 2010. Now it's 2023, 13 years later. It had taken me so long to write this book. And my second book, we exited from it in 2005. And I published the book only in 2021, right? So with no deadline, you know, you can spend all your spare time trying to write books. But you talk about NDA, non-disclosure agreement, and so forth. Nothing, you know, after the passage of time, nothing is secret anymore. If it's still secret, you wouldn't read about it. I wouldn't write about it. You know, John was saying that he dealt with Kim and Chan, a law firm in Korea. And we used Kim and Chan in our acquisition of Korea First Bank. And after I put together a manuscript for Money Games, I sent it to them. And they did some censoring. They said, well, no, this is not, you know, not good if you disclose it. So I was very careful not to disclose any confidential information. Honestly, with passage of time, almost nothing is so confidential.
So passage of time was certainly helpful. What about, to go deeper into this, what about, because you talk a lot about the quality of the bank, and we'll go into the banking system in a minute, but just talking about this particular asset, as you were acquiring it because it was a bad bank. You knew it was a bad bank, they knew it was a bad bank, but how did you manage the delicate relationships? Again, back to this interesting character, Zhou Lin. He was managing a bad bank, and so you had to go in and do this deal while, frankly, disparaging the asset that you were trying to buy. And we all know how important in Chinese culture, you know, face, respect. I mean, were they not humiliated?
We were not disparaging the asset quality. In fact, we find it very difficult to disclose the asset quality because the bank was a public bank. And if we said anything different from reported by EY or some other accounting firms, then that would cause a lot of problems. And we conducted our due diligence, and I shared that due diligence report, which revealed deep problems with this bank. I shared the report with only 2 people, the governor of the central bank and the chairman of China's Banking Regulatory Commission. But the managers of the bank were fully aware of the bad quality of their assets. And that is the reason why they were supportive for a foreign investor like ourselves to take over control of this bank. It was like a hot potato in their hand. They wanted somebody to come in to help with it. But along the way, of course, they wanted somebody who is friendly, who would be on their side, and then frictions arose. And so there were issues between us. But there was really nothing that we would hide from regulators. And you can't. You will have to be totally transparent with the regulators and with the management.
No, it's fascinating. And again, the book itself, there's so many characters, the CBRC, Zhou Xiaochuan, and people like that. It's just so many fascinating characters. It really does read like a novel. And I don't want to give anything away, but at one point, you actually did take yourself out of the deal in order to save the deal, which I thought was fascinating.
Right, because the government side, on the other side, was very displeased with me. So they'd rather that I did not join the board after we took over control of that bank.
Fascinating. Let's get those questions collected, because I really do want to bring some questions from the audience if we have those. And while we do that, why don't we talk about the banking system itself? So Professor Yang actually brought that up, and I think this is going to be on the mind of a lot of people right now, is our banking system here in the US, Silicon Valley Bank, very different problems. You were dealing with SDP because it had the non-performing loans, whereas the Silicon Valley Bank had a very different kind of problem. But still, what can we learn from your experience looking at how the banking system itself changed in China, and your experience? You fixed not one but two banks, at least that I know of. So given your experience, what can you tell us about what's going on in the banking system here in the United States, and Silicon Valley Bank in particular?
I think that what happened to SVB and some other regional banks is not so much the issue of interest rate rises, but it's more of an issue of regulatory deficiency. Let me explain what I mean. Of course, we all know in the past year or so, 12 to 18 months, the Fed has increased interest rates very rapidly. And if you hold long-term government bonds, treasury bills, let's say 30-year treasury bills, when interest rate increases, the price of the treasury bills will come down. So if you have to mark to market, then it may be worth 1 billion last month, and today it may be worth 900 million, and tomorrow 800 million. So there are mark-to-market losses with Silicon Valley Bank and some other banks. And that appeared to be an issue, but typically banks would hold these assets to so-called maturity. So they have two accounts, hold to maturity or available for trading. If you hold to maturity, then you don't have to realize the losses. And eventually, you get your principal back from the federal government. Let's say a 10-year treasury bills. I shouldn't have used 30 years because banks typically will not hold such a long instrument. So ostensibly, the increase in interest rates would put pressure on the asset quality of banks because the value appears to be impaired. But since they are in hold-to-maturity account, you don't have to realize any of the losses. Eventually, you will get your principal back. That's too technical. The issue is, if people started to worry about the safety of the bank and pull money out of the bank, and that is called bank run. Once the run starts, then you can't stop it, right? If you don't have enough liquid assets to to sell, to generate cash, to pay your depositors, then you go bankrupt. A bank run would bring a bank bankrupt. During the Great Depression, some economic crisis in the United States that happened before. In 2008, a number of banks went bankrupt because of bank runs. For example, Washington Mutual, to the last day, it had enough capital, but it didn't have liquidity. It didn't have cash to give it back to depositors. Regulators have a responsibility to make sure that banks are tightly regulated so they have enough liquidity to meet any demand for cash. And I think regulators dropped the ball in this particular case because in the United States, banks will not be regarded as systemic risk bank if their assets, total assets, are less than $250 billion. Silicon Valley Bank was less than $250 billion. It was about $200 billion. If you're not regarded as a systemic risk bank, the regulation is much more lax than if you were regarded as a systemic risk bank like JP Morgan and Citibank. So there was not enough liquidity with Silicon Valley Bank, with Signature Bank, and so forth. It's not so much because of the interest rates. Why do I know this? Hong Kong, where I live, doesn't have a central bank. It doesn't have its own monetary policy. Its monetary policy is determined by the Federal Reserve System of the United States. Why is that the case? Because the Hong Kong currency is pegged to the US dollar. We operate a currency board system by which if you issue one Hong Kong dollar, you will have to put 1 divided by 7.8 US dollars into the Hong Kong monetary authorities. So every Hong Kong dollar is backed by the US dollar. Consequently, when the Fed increases interest rates, Hong Kong increases its interest rates, and vice versa. So Hong Kong doesn't have monetary policy. It's the same monetary policy as the Fed. But we don't have a banking problem because the regulators over there regulate every bank like a systemic risk bank. They wanted to make sure your liquid asset ratio is high enough to meet any demand. And in 2008, in fact, HKMA, Hong Kong Monetary Authorities, as soon as the financial crisis happened in the United States, they announced that they would backstop all the deposits, regardless of the amount. There's no limit of all the banks in Hong Kong, and therefore there was no bank run. So regulators can do a lot to protect the banking system. I think there's not sufficient oversight of regional banks in this country to have caused the problem.
Whereas in China, maybe they almost had the opposite problem, because I'm sort of curious, in your view, why did we not see, in the case of Shenzhen Development Bank, we did not see a bank run. I mean, again, it's a different system and a different problem.
At that time, in 2002 or early 2000, the Chinese banking system was very weak, technically insolvent. They stood, didn't go bankrupt by and large. One bank did go bankrupt. That's Hainan Development Bank did go bankrupt. But by and large, they stood firm because there was implicit guarantee by the Ministry of Finance that the government was behind it. And today, the situation is very different. In fact, the Chinese banking system today is very healthy. Their capital ratio is higher than in the United States. That is, the banking system in the United States. The United States used to have, in 2021, the liquid asset ratio in the banking system in the United States was 22%. Today, it's only 17%. Somehow, the regulators just dropped the ball and let banks operate without enough liquidity. But in China, as in Hong Kong, the regulation is extremely tight. Capital ratio is high. There are some other measures that they take to make sure that the banking system is solid, is healthy.
Yeah, that's very true. In China, not only is the the banking system itself quite solid, but the banks themselves are quite competitive. You made a reference to that in your remarks earlier about competition between the foreign banks and the domestic banks, and how that was a requirement, that they didn't want the foreign banks to come in and basically take over the market. At this point, the biggest, strongest banks, and also the most technologically advanced, are often the Chinese banks and not the foreign banks in China. Do you agree with that?
Well, I think they have very simple products.
Yeah.
And after the early 2000s, there were some regulations which are very draconian, but probably more suitable for the Chinese banking system. For example, it used to be the case, a loan officer, this was before the banking reform of 2002 or 2003, it used to be the case, a loan officer would be able to make a loan by himself. The president of the bank would be able to make a loan. I just read yesterday that the last culprit of the worst banking corruption case in China was brought to court yesterday in China. And this was after about 20 years. And a few people were able to embezzle 460 million US dollars from a small branch of Bank of China called Kaiping branch. So at that time, the banking system was very weak. As I mentioned, a lot of bad loans. But after the banking reform, some new rules were put in place, including decisions on credit will be made by a committee, not by individuals. And that, of course, would prevent corruption, kickbacks and all that. And including, if somebody makes a bad loan, he's responsible for life, even after retirement. And the punishment will be very severe. So I think the problem with much of China's banking system, as in Hong Kong as well, the Chinese banks at least over there, is they're so afraid of making risks. And therefore, they suffer on ROE, that is return on equity. If you don't take risks, of course, you wouldn't generate enough profit. So they have a reverse problem.
That's great. That actually segues nicely into our first question from the audience. And I'm going to expand this a little bit. The question is, do you see more of the public investing into private equity firms rather than the stock market for the foreseeable future? And if you can answer that question, and also talk a little bit about the world of private equity itself, and again, for the benefit of students that are looking at private equity as a career, and also those of us out there who sort of have the desire to be a little judgy about private equity. I mean, and you make a few points about that in your book, describing what the function of private equity actually is, and you defend it a little bit. It's not just an industry that makes very wealthy people even wealthier. You make the point in the book that private equity firms are actually managing money on behalf of the pension funds and ordinary people that want to get a decent return on their investment. But I wonder if you could just talk about that, about private equity generally, and the question again is about returns in private equity versus the stock market, things like that.
Kurt, your question is too loaded. Too many questions in your question. First of all, you talk about the public investing in private equity. Now, in this country, starting, for example, Blackstone will raise capital from retail investors. Outside of the United States, by and large, retail investors are not allowed to invest in private equity because you are not qualified. Private equity is considered to be high return and high risk.
Too risky.
Yeah, so only institutional investors, like state pension funds, corporate pension funds, sovereign wealth funds, would invest with people like ourselves. And to your second question, I think you asked a very good question. How does private equity make money? And that's the reason why I wrote these two books, Money Games and Money Machine. There's a notion, if you invest in public market, Of course, you try to buy at the lowest point, you try to sell at the highest point. Buy and sell is what you do. You do trading. In private equity, that's not how you make money. You may think that the price is very low, but the market can go even lower, right? And if you assume that the market is somewhat efficient, then you wouldn't be able to invest billions of dollars when you buy at low price, lower than what the fair market value is, and you will be able to sell at a price higher than fair market value. That game really doesn't work. So how do private equity create money and create value? We do it, and that's why Henry Kravis says, it is what happens after you have bought the company that really matters. We bought Korea First Bank out of bankruptcy. It was a failed bank, and we bought it from the Korean government. And what we needed to do was to turn around the operation of this bank. We have to improve its operations. We have to install a risk management system. We have to build a credit culture. We have to train our people, and we have to improve the asset quality, and we have to grow the bank. Eventually, we grew the bank 3 times in size in 5 years and made it very profitable from a loss of $100 million, a few $100 million per year, to a profit of a few $100 million per year. Look at Shenzhen Development Bank. When we bought it in 2005, the financial report in 2004 says its bad loan ratio was 11.4%. The actual was twice as bad. The capital ratio required by the regulators was 8%, but the capital ratio reported by this bank was 2.3%. It was not profitable. 5 years later, we grew the capital ratio to more than 10%, from a nominal 2.3% to 10% solid. And we brought down the bad loan ratio from nominally 11.4%, actual 20%, to less than 1%. And we grew profitability from a loss to $1 billion per year. We invested $150 million, and we sold our stake for $2.4 billion. That's how we created value, because we improved the operation of the bank. We grew that bank by 4 times and made it very profitable. That's the right way for private equity to make money. If you want to make money over a long period of time, I'm in this business for 25 years. If you want to consistently make 20-25% return for your investors, the only way to do it is to create value, add value by improving the operations of the target companies. For that, you will have to have people who have capabilities to do so. We invested in a company here in the United States by name of Lexmark. And the chairman of Lexmark today is a printer company. I hope you use Lexmark. Printers. The chairman of Lexmark is Philip Kasu, sitting right here. And he is alumnus of USF. And he was a long-time veteran, senior executive of IBM. So he knew this business, and that's why after we bought Lexmark, we approached him. We said, can you help us, right? And we need people who are experienced, who have the knowledge, who know the best practices to help improve the operation of the company. The company was not doing well, but under our stewardship, with world-class executives like Philip Kasu, we were able to improve the value of this company. That's how we create value.
Yeah, and that's exactly what you did with SDP as well, bringing in Frank Newman to turn around the bank. So it's a fair point. I actually do have a follow-up question, which is even more of a loaded question. But since you're talking about private equity and investment banking, you moved from JP Morgan as an investment banker to private equity. You made a little bit of a snarky comment in your book that I wanted to challenge you on, because I came from the investment banking world, and you made a comment that investment banking is 80% social and only 20% the real work, which is what you were interested in. What did you mean by that? And I'm going to try not to take offense.
You shouldn't, because that remark was made in the context of China in 1990s, right? When China first came to the international capital markets, China listed the first stock in 1994 on Hong Kong Stock Exchange. And at that time, there were only very few Chinese companies going public. And every investment bank all over the world tried to get the mandates. JP Morgan, Morgan Stanley, Goldman Sachs, Nomura, everyone, the Europeans, Paribas and so forth, everyone wanted to get a mandate. So it was very competitive. And how do you get a mandate? You have to spend a lot of time socializing with the clients. And I hated that part. I really hated that part. Because the work was relatively simple. And that's why I said it was 20% financial engineering, 80% social engineering. And it was the social engineering part that I hated. But now the market has become much more sophisticated. Now I don't think that you need to socialize with people anymore. Now it is your investment banking capabilities, your abilities to help your clients that really matters. The time has changed.
Exactly.
So your job is okay.
No, I wouldn't disagree with you. It's the 80%, it's the socializing part that I really loved about investment banking. So you and I could be a perfect team.
Yes.
I think that we do have another question, but I think it's going to take too long to both ask and answer it. It's about the construction industry and the future of China, the Chinese economy going forward, especially given the decline in population. But I think that the answer for that question is probably going to take more time than we have. Therefore, I want to just end with one last question. Just given the fact that USF, it is all about the students. You're a returning alum. What advice, as we wrap up our program here, what advice would you have for students today?
I think the only thing that I can say is that learning is a never-ending process. If I had not studied on my own when I was a hard laborer in the Gobi Desert, then after 10 years of no schooling, when China opened up, I wouldn't have been able to seize the opportunity to come to the United States. And in my experience, if you continue to learn, then you open doors to good opportunities. So, after graduation, some people throw their books away. I think learning is a lifelong experience, and you have to do it. But I try to think about what it takes to be successful in investment, in business, or almost in anything. There is a psychologist by the name of Angela Duckworth, who a few years ago published a book called Grit. And she said that in order to be successful in your career or in doing anything, you have to have grit, tenacity, persistence, perseverance, hard work. And when I reflect on her book, I think that there's something more important than grit. Grit is very important. Hard working is very important. And that is judgment. Because if you don't make right decisions, it's like running a cross-country race. If you lose direction, lose your way, then the more grit you have, the more counterproductive, more futile you will be. So you have to have very good judgment. How do you have good judgment? You're not born with good judgment to make the right decisions. It comes from knowledge. It comes from experience. It comes from learning, from books, from experiences, from people around you. So only by continuously learning can you develop good judgment. And then I think there's also a third factor, which is very important, we all have to bear in mind, and that is luck. It's very important. Some people let their string of success to their head. They think it's all because of their brilliance. When in fact, you can be lucky, you can be unlucky, right? Luck plays a very important role. I consider myself to be extremely lucky to have met with Mrs. Kasu and Philip Kasu, to have come to USF. And that was my biggest break in life. That changed my life. And if you don't realize that, you are not humble enough, and then you will not be able to constantly learn. So I think humility would really help you in your career, so you can learn from almost anyone, and that is very important.
Well, Shan, it's certainly been our luck. It's certainly been our luck here at USF that you found us, and that you learned as much as you did, and now you're here giving back to the university, and we very much appreciate it. Shan, it's been a delight talking with you. I really appreciate it. I love the book. I've read the Gobi and this one. I haven't read the second one, so I've got to go back and do that. But it's been an absolute pleasure speaking with you. Thank you so much.
Thank you. Thank you. Thank you so much.
We do have a token appreciation
Thank you.
for you.
What is it?
I'm afraid that it will be up to you to actually open.
Thank you so very much. Really appreciate it.
Great note to yes, I have a couple of words here. Thank you. This is on behalf of the CBSI board and the university, I wish to thank Dr. Shan for taking time out of his crowded schedule to give us the talk, amazing talk. Being in San Francisco, nobody will always hear about VC, right? VC investment. Very rare we actually hear something about PE, private equity investment. So this is refreshing. And in fact, to me, VC as they grow, they probably will go to that path, right? From VC to PE. So hopefully there will be more of this coming here. So we are very grateful to you for sharing your stories, insights, wisdom with us. I also want to thank John Nikolai and Ker Gibbs for your great support here today. I wish to thank all of you for being here. I trust that you have many takeaways to digest and apply in your own work. And for our students, I trust this is an inspiring moment in your 4 years or 2 years, whatever, your study time here. In a not too long future, I hope to bring back many more Shans among you. This is for you, students. An event like this is not possible without dedication and tireless effort of a talented professional team. CBSI board wishes to thank Mario Palazzo back there, Associate Vice President, and Yvette Torres, who's been busy, floating around, Senior Director for Special Events in the Development Office, and your team for organizing this event. Last but not least, please continue to support CBSI and partner with us to create more bridges, not walls, and more prosperity, not poverty, peace, not war, in the Asia-Pacific region and around the globe. Please join us for a little more mingling and networking, And thank you again for coming today. And